Hello, welcome to Financial Statement Introduction class. This class and next three class we will spend time on learning about different financial statements. There are mainly three financial statements which we will cover in this class and next three class. In previous class you have seen few numbers from the perspective of a businessman, and obviously the choices which he had in terms of growing his business. And then you also saw that what are different choices you have when you want to go and invest into some companies or some businesses, right? So, to understand that in a better format, obviously we have to go and find out numbers. And these numbers are available nowhere but in these financial statements, right? So, financial statements are the core of any fundamental analysis. Qualitative analysis, you learned, you saw it that we did it mostly through conversation, understanding different businesses, doing case studies, doing SWOT analysis, and all the other business metrics, applying the business metrics, right? But we were not discussing about numbers there. And in financial statement classes, we will discuss about numbers, right? So obviously every person have a philosophy, right? Philosophy of investment. You also have to develop your philosophy of investment, which might differ from my philosophy of investment. So as a learner, or me as a guy who is probably explaining you this, we might differ on certain things, and it is completely fine there. Okay, so I'm one person who would look at quality first, and then I'll come down to quantity or quantitative research, where I'll go and place my bets on different numbers. But before placing my bets on number, I would certainly see that whether I'm into good quality of businesses or not. However, you could be one person who will go directly and jump on the financial statements and try to find good companies based on number, and then you will check their quality. It is completely fine. Okay, but what is important that you understand both aspect. So in financial statement, obviously many people have apprehension. I know that this course will be taken by people who are from engineering background, non-science background, non-commerce background, medical students, lawyers, and people from all fraternity. So it is very critical that I don't make it complicated. So what we will do in the financial statement analysis class, we will directly jump on these statements through two websites, screener.in and money control. Some people might be comfortable with money control, some people will be comfortable for a screener. So we will see all these statements, do some analysis for different companies, compare them as well, and then we will move forward. So I'll try to make it a interesting proposition for everyone. So don't consider it that you are doing accountancy class. Since it's a stock market course, we will talk about only those companies which are listed companies, which stocks are available. So our knowledge, our coverage area will be restricted to only that aspect of the financial statement. Okay, so what we are not going to learn here is how to create a balance sheet, probably. What are the things you have to be taking care of when you are preparing a balance sheet. That's a job of an accountant. You are not an accountant, yes. Even being a stock market investor or a person who is planning to make a career, it is always good when you go and do things in detail. But in this course, we will not go bookish, but we will directly see those financial statements through these websites and try to compare between 2 3 different companies of the same sector and try to make some sense out of it. Obviously in further classes, for relative valuation, we will learn about different ratio analysis, and that time also you need to refer to these financial statements. So most of the ratios are readily available, but if you really want to be confident, you may calculate those ratios taking the numbers from these financial statements, right? So next three class, we will jump to the statements and practically learn. But this class is going to be a fully theoretical class. I want you to make a note of these. I want you to remember few things as well, so that it always get imprinted in your memory that okay, these are the statements and these are their needs. This is the purpose. So I have written the pointers also in that fashion so that you can remember it, recall it, and visualize it for future purpose as well. So I'll read out for you and then explain it to you. So financial statements. Financial statements are written record that convey the business activities and the financial performance of a company, right? So which one is for the business activity or which one will tell you the financial performance is something, obviously when we will bifurcate all the three statements, we will get into detail. But yes, they have to be there as a record for the purpose of auditing by government agencies, accountants, and different firms, to also ensure that things are accurate, taxation issue is taken care, and when these companies are going for financing or investing purpose in the market, they can show their track record as well, that okay, these are the things which we have recorded, we have filed it to the government, got it audited, and everything is perfect here. So for that purpose also financial statements are quite important. Apart from that, it convey you certain things like its financial performance and the business activities. What you will learn about in financial statements is looking at the number before investing into the companies. So that's the reason you need to know financial statements. Then, what are the three financial statements? Generally, the order is balance sheet, profit and loss statement, and cash flow statement. But in this class and even in the next class, we will reverse the order. We will first learn about profit and loss statement, then balance sheet, and then cash flow statement. Coming to profit and loss statements, it is also called income statement. So as the name suggests, it's very simple. Profit and loss. Every company is doing certain activities, selling product or services. For what purpose? Obviously for making profit and growing the company. But sometimes these companies can make a loss also. And that's why we call it profit and loss statement, which needs to be reported every year, every quarter as well, right? So we call a thing called quarterly result also. In quarterly result, they generally publish their income statements. Everything has to be audited every quarter. Everything has to be, entered every quarter, but they need to be filed in a quarter and in a year. But audited is something which you will do for an year. That's what accountant do. But here, when we are talking about profit and loss statement, and when I mentioned you about also quarterly results, something which you need to understand here is profit and loss statement will be on quarter basis as well and on annual basis as well. So annually they will also show you profit and loss statement. What you will also see that many at the places, especially in money control or even screener, they will mention a term TTM. It will say that last four, so fiscal year work from April to March. Now, April to March, you have 4 quarters, right? But then many of the time you would be interested in knowing an annual profit or loss of that company. Why it is more critical to look at annual number is because in every quarter most of the businesses are cyclical business. So I think I have mentioned this even in previous classes that certain businesses do well in certain season, certain cycle, certain month, certain quarter, right? So quarterly results and quarterly profit and loss statement will not give you a very correct picture what a annual profit and loss statement will show you. But then you need to do the analysis every quarter, right? Now the annual profit and loss statement will be published only after March, up to March. But what happens in the in between if you have to do that analysis? So what you will do that you will take last 4 quarter when you take, that's how they denote it to TTM, when we will go to the profit and loss statement, I'll show you that. Right. So income statement provides an overview of revenue, expense, net income, and earning per share. Obviously, so profit and loss, how it will come? It will come when you make certain revenue. To generate that revenue, you have to spend money, and whatever will be left out will be the net income. Well, there will be many more other terms in between which we will deal when we will go to the profit and loss statement detailed class, which will be the very next class. Right now, when you have to remember about profit and loss statement, what you have to remember is that P&L statement will provide information about whether a company can generate profit by increasing revenue, reducing cost, or by both. So this much is of revenue. You have this cost. So whatever is left is the gap, which is the profit. Right now, you can increase the revenue with the same cost. You can decrease your cost. So it is not very easy to see it as standalone, what you have to remember. But what you can always go and check when you are doing a relative valuation. Every time I talk about relative valuation, because I'm giving you a theory of portfolio management. As a retail investor, when you come into market and try to invest, what you have to always remember is market will go up, down, and all these things will happen. But few basic theories will be always there, which is like you have to create a good portfolio of stocks. When I say good portfolio of stocks, you will have a limitation to identify which is the best one, right? So you will always do comparison. You will do the comparison among different sectors. You will do comparison among different stocks, right? And then you will find out that which stock is the best among the lot within that sector. So when it comes to the profit and loss statement, standalone, when you see a profit and loss statement of one company, it will be very difficult to tell you whether there is a scope to increase the profit or not. There is a scope of increasing the revenue with the existing cost or not. There is a scope of decreasing the revenue cost or not, or both of the things. How? When you will see that other companies are able to do it with the same efficiency, right? So this is how you will use profit and loss statement, apart from obviously looking at the numbers, that okay, this company has been making profit, right? This much is their efficiency in terms of generating profit. It's not only about the sales, right? Yes, a company has to do a lot of sales, work on economy of scale, but at the same point of time, it has to be very, very efficient in terms of posting profit, right? So you remember that profit and loss statement will have a purpose in your analysis, and that purpose will be to analyze whether this company can be more efficient in terms of generating more profit, either by increasing the revenue or by decreasing the cost, right? So why I made this point, because everything has a purpose. When we are doing this class has a purpose, and when we are going to look at the profit and loss statement, there should be a purpose, there should be an agenda, that okay, for this reason I'm going to check the profit and loss statement, and this is how I have to do it, right? When we would be doing a class on accounting and understanding about how to create a profit loss statement, this lecture could have been a different lecture altogether. But here, when we are assuming that most of us are planning to learn for the very first time how to make sense out of the financial statements as a fundamental analyst, then I would say that focus on doing the relative analysis by comparing profit and loss statements of different companies within a sector, and try to see this factor which I have highlighted here. Now, balance sheet. So it is a financial statement that provides a snapshot of a company, what a company owns and owes, as well as the amount invested by shareholder, right? So companies will be started by people, though company and people are two different entities, but it will be started by someone. And when they will start company, what will happen that they will need more resources, which they can generate through taking debt. So every time they take debt, that is something what they have to return. There are so many other things which will come into liability, or you can say there are so many other heads where they will owe things to others. Owe things to other means they have to pay it. For example, they are manufacturing something, and to manufacture that product they need raw material. So there will be people who will be supplying them material, called suppliers of the raw material. They may have a term where they will be paying after 3 months for all the raw material, right? So when they will be paying after 3 months, obviously they owe money to people who have supplied them raw material. Now, the loan which they have taken, the money which they have to pay to the supplier, which they have not paid yet, is all something you can put into a category of what you owe to others. And everything which you build, everything which you own, you have a factory, you have cash in hand, and this cash would have come from promoters, or even if it have come through debt or through generating profit within the company, this is all what you own, right? So this balance sheet actually tells you a clear picture about one company, that what this company own at any point of time. At any point of time means in the last fiscal year when this balance sheet was audited and reported, at that point of time, what exactly was the situation of this company in terms of how much they own, how much they owe to others, and how much people who are involved in this company, who invested into this company, or who started this company, or one more thing here is what company have made in the operations in last 4 5 10 years, or from whatever time it started. What I'm trying to tell you is, when few promoters start a company, yes, that capital you can see in the balance sheet, but then within the same head what you will also see is company, is what the company has generated in terms of profit and have been keeping you with them, right? So if they have to pay something, one is the terms and condition, right? That okay, I have to pay after 3 months, so I'll pay after 3 months only. But then you have long-term loans which you have taken, which you could have paid immediately if you have a lot of money which you have generated. But you will see that lot many companies will at any point of time will have debt on them as well, and keeping the retained profit also with them, because they may use that profit for the further expansion, right? So that head will be clubbed together with whatever amount promoters have invested to start this company, or shareholders have further put into this company at the time of the IPO. Overall, it is one snapshot, which is the most important snapshot of a company, the balance sheet. It provides a basis for computing rate of return and evaluating its capital structure. What I was telling you is about the capital structure. What I mean to say here, that when you know that you own something and you owe something, you understand what is your net worth, right? And when you club it with profit and loss statement, then only you will be able to see that how much money you have been making in terms of percentage of return. So balance sheet is very important from your perspective, because it is the combination of balance sheet and profit loss statement which will tell you that at what rate this company is making profit or making return on its own capital, right? Apart from that, obviously it will tell you that what you own and owe at any point of time, what is the money which a promoter have invested into this company, right? So I already have told you that what you have to always remember about balance sheet is that when you want to go and see the most important snapshot of a company, you have to look at balance sheet and you have to visualize it, assuming that you want to understand one company is making what kind of return in its capital, on its capital, invested capital, by combining it with profit and loss statement. So very few key things you have to remember, right? So when I talk about profit and loss statement, you have to remember, I know I'm repeating it in a class, but when you are talking about profit and loss statement, You have to remember that how efficient one company is already in comparison with others, and also if there is any scope whether this company profitability can increase or decrease. When you come to the balance sheet, what you have to remember, the most critical thing according to me is you have to remember that what's the kind of return this company is making. This is a very theoretical class, but then some sense I'm trying to make here in terms of asking you to remember few things, right? Though when we will do the relative valuation classes through ratios, many of the numbers will come from these three balance sheets, three financial statements, but then balance sheet, profit loss statement, and cash flow will have its own purpose, should have its own purpose in your analysis, fundamental analysis. What I also do is something which I'm sharing you. Let's move to the cash flow statement. So it is a financial statement that summarizes the amount of cash and cash equivalent entering and leaving a company. Well, to explain you the importance of this, I'll give you one situation. So the situation is you have vendor who are supplying material to you, suppliers you can say, right? If you are not paying them in time, your reputation will be at stake. Good suppliers or vendor will not come to your company to bid, right? Then it is very important that being an ethical company, being a very efficient company, you pay all your supplier in time. Now, when you want to pay them in time, you also want to receive your money in time, right? So the products or the services which you have given to your client, you may want to have a very good system through which you are able to take your money also from your client in time so that you can pay your vendor in time. Now, the cash movement, and this all things will happen in obviously cash movement. You will pay in cash, you will receive in cash. So to understand the fluidity of the cash within a company, what you need to look at is the cash flow statement. Remember the word flow. So the cash has to flow like a water, flow like water. So something like, the river water, which is flowing, not a water in the pond, right? So the cash flow should be as lucid, as fluid like river water. And then only you will say that, okay, my company's cash management is really well. At no point of time in this company, there will be a deadlock where you are not able to pay your vendors, your employees, or you have sold so many stuff to a client who is not capable to pay you and your money is stuck. So cash flow statement give you this picture, that any specific company is utilizing its cash in how efficient manner. So the cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligation and fund its operational expenses, right? So obviously company does lot many things and they have to do a lot of things. Screening of vendors, a screening of client, everything is important, right? You cannot, let's say you are into a B2 business to business, you cannot make anyone client just because someone want to buy stuff from you. This doesn't mean that without screening them you will make them client. If you are doing that, obviously you can be in fix. Even if you are working on 20% margin, out of 10 clients, if 2 clients become such who are not paying you in time, who have been holding your payments from a lot of time, then what will happen that your company's operation will get stuck. Even though when you are producing things, doing good jobs, selling a lot of stuff, but not making money for the company, right? So cash flow statement analysis, you will do as a fundamental analyst to use cash flow statement to understand liquidity and fluidity of the business. So any business fluidity and liquidity you will understand from the cash flow statement. So yes, everything is important here. What's the capital structure of a company is something you need to understand. How much company owns and owe is something what you need to understand. You learn that in balance sheet. how much money a company is making, whether they have posted profit or loss, and while posting this profit and loss relatively, how good they were in comparison with its peer is something what your profit and loss statement will say. And cash flow is will tell you the fluidity of cash within the company, as cash is very, very important for the operation of any company. On this note, I will close this chapter and jump to profit and loss statement chapter, where we will understand different terminology of profit and loss statement, and then see profit and loss statement along with quarterly results of few companies both on Money Control and Skinner.in. Thank you.